Sadly for small companies, it's been a difficult year, as was 2022. Combination of reasons. With rising rates, people have taken an opportunity to sell positions in what they look at as a risky part of the market. But in actual fact, small companies have held up their profitability quite well. Over the last year, we've seen a derating of the sector versus large caps, but their profitability is still rising. So that ultimately means that they are now cheaper than they were, or they have derated against large caps again for the second year in a row. We're now in a position where it's almost unprecedented. Small caps did derate quite dramatically during the GFC, but we're almost at those levels now. So we've had three lows in the market. We had June and September in 2022, and now we've had October in 2023, which have been low points in the small cap market. We've seen a small bounce since, but we see excellent value in the space. There are three main risks going forward over the next year as we see it. Two international, one domestic. The domestic one is that the RBA raises rates too far or too aggressively, and that leads to unemployment, which leads to issues with credit quality, spending, etc. So that's an obvious risk to the market. It's not our base case, but that is a risk. The other two are the US, and with the US, if in the same situation, rates have gone up, inflation is coming down, but if rates stay high for too long, or if the country starts to slip as far as its economic growth, the equity markets will come back. And the third, and very importantly for Australia, is China. Obviously, with the slowdown in China, they're sitting in a situation where they're very close to disinflation. If that continues, and if we do see a slowdown more than expectation in the Chinese economy, that would obviously be damaging for the Australian economy as well. Again, not our base case, and nor is the US. I think at the moment China is probably looking a little bit better than feared probably a couple of months ago. US growth continues to surprise on the upside, and in Australia, not too hot, not too cold at the moment. Still things to worry about, but at the moment companies are actually doing surprisingly well. As a small cap manager, and to put that into context, our core portfolio sits between stocks 101 and 300 in the ASX, with a small amount outside that part of the market. So what we're seeing at the moment is the small cap market derated. So these stocks have been getting cheaper and the valuations look absolutely compelling at the moment. So the small cap market we think is still very attractive. What's interesting is that the lower end of that range of stocks is where the valuation gaps really exist at the moment, where there's real upside. So we are looking at that part of the market because when things do improve, these are companies that will re-rate. They have good management teams, they're well capitalised, they make money, and they're in parts of the market that you can get exposure to. So we think there are certain sectors that still look quite attractive. A good example is travel and tourism. Now, we don't think that parts of that market have recovered even to where they were in 2019 before COVID, and so we think there's still some very good upside in some of those stocks. They've come back, so their valuations look quite compelling as well. And another part of the market that we're finding attractive at the moment is companies that are exposed to both the resource sector or the infrastructure spending in Australia. There are some very good opportunities in that space. We find them quite undervalued at the moment, but we think that the resource sector will continue to spend. They're doing well. And the infrastructure spend, it may come off the high expectations with state budgets not in exactly their best shape, but a lot of companies have still got a good pipeline of work for the next 3 to 5 years. So that's an area of the market we find quite attractive as well. The opportunity, as it sits now, looks pretty promising. And I say that because we have seen the largest D-rate in small companies since the GFC. And what was interesting during the GFC, the D-rate only lasted a short period of time, and then small caps outperformed large caps quite dramatically and quite quickly. This downturn has taken longer, but it's not just an Australian phenomenon, it's actually global. US small caps, British small caps, European small caps have all underperformed large caps, which is confidence and liquidity in probably what is the high growth part of the market. So that doesn't last forever. The opportunity gap between the valuation on large cap and small cap is extreme. So we think that that will revert at some stage when a bit of confidence comes back into the market, and I think 2024 is very promising for small caps.